All right, hey everyone, here it is Friday afternoon. The market's just closed and it's been a wild ride this week. So let's take a look at what the charts say and try to digest that. Now, one thing we're going to do here this afternoon is spend quite a bit of time looking at Fibonacci retracements so that you can kind of see up, down, where the targets might be depending on whenever these grains decide to break out of the ranges and move forward. And so if you look at Kansas City wheat, which is what I have in front of you here, yesterday we drew this red box and we said, hey, anything out the bottom of that we want to sell, anything out the top of that we probably want to buy. Well, it tested us to the downside and put us right back into the middle. And then we put our cloud on here so you can see exactly what it did there. It retraced right back to the top of its daily cloud. So this is really in a position where it could go either way. And if you look back since December, we've traded about $9 to $7.75, right? So we've traded about $1.25, $1.50 range for several months. And whenever these ranges give way and we really do get a breakout, then I would expect this market to move dramatically whichever way it goes. And so I don't think that this nearby volatility is out of context for what is coming. In fact, I think it's just a precursor for it. So let's look at what the Fibonacci extensions say for both the bullish and the bearish counts, okay? And whenever you run these, choosing your time frame is really important. So I'm going to choose the most extreme ends of the ranges that we have going back over the last 10 months back to September. So I'm going to use this low here in March. I'm going to use this high back here in October because they're the two most recent extremes that haven't been overlapped a whole bunch of times. Okay, I hope that makes sense. You can choose this point, you can choose this one, you can choose any one of these lows. But if you really want to get an idea of the magnitude of what could come, then you want to use these extremes. So if I click on my relative retracement, which remember, this is a Fibonacci target that draws off of this low. The chart looks all the way back, and it finds the highest high and the lowest low looking all the way back to the beginning of the contract. So this is pulling 38.2% retracement all the way from this high back here, which is the all-time high, okay? And then at that point, it draws what's called a magnet. So you have 38.2 up to it, 61.8, and then your magnet, and then above that, you have your extensions. Now, this seems super unrealistic, right? Knowing what we know and knowing what we understand about the corn balance sheet, the wheat balance sheet, the global food supply, and all of those bearish fundamentals, this seems really unfathomable. And I don't disagree with that at all, but nevertheless, it's here. So you could see wheat retrace to 935 at 38.2% of its big move down. 1040, 61.8. If it wants to retrace all of it, it's got to go all the way to 1170. Now remember, that's just off of this July contract. If it goes off the continuation, it's even higher. And then if you want to extend that move up, then it projects to something north of 1370, $15, something like that. I'm not saying that that is what's going to happen. Don't misunderstand me at all, because we're actually looking at the opposite side of this thing in the grain complex, not the bullish side. But if we do break up higher, we want to give it lots of room and space because the upside really could be dramatic. But now let's take a look at the downside and see what this does. Now, I don't want anybody to get real depressed, but here's what the downside drawn from this peak is. So it looks back to the high and it measures from here down to the low, and then it grabs the intermediate high, okay? So if you do this math here and you run an extension off of it, the 1.38 extension, it counts to $7.31. Here's the 1.618 at 686, all the way down to 561, down to 484 on Kansas City wheat. Now, that seems more likely than $16 Kansas City wheat, just because we know that prior to the invasion in the Ukraine and prior to kind of this global food shortage that we've had, you end up having much, much lower prices. So I'm not saying we're going down here, but to me, it makes the most sense with normal weather that even with our drought in western Kansas, that we would look for a downward breakout. But that's just our current understanding, and if something were to happen globally, that would push a bunch of wheat demand our direction, or collapse our crop even more, or collapse somewhere in global supply where wheat gets tighter, then that could be the bullish catalyst moving forward. Remember, when we're talking about wheat, we're talking about bread and food supply. And some of the analysts that we read a few weeks ago started talking about a huge black swan demand event for Kansas City wheat. And if that were to materialize, then you'd be looking at these upward targets. But until it does, I think it's safest to say, hey, outside of this cloud, we're going to short it. We're not going to sweat it. If those demand fundamentals were to materialize and we need to send this thing much higher, then we're going to have plenty of opportunity because we got to come up out of this cloud and ultimately take out all of this stuff before we get to higher highs. So that's how we're thinking about it. Lower we look. And here's another reason why we think we're looking lower. Okay, here is old crop corn. This is what we drew out for you yesterday. You can see we clearly fell out the bottom of this red box here. We fell out the bottom of our daily cloud. We overtook our trend line, and we ended up with taking out and closing below the 612 low, or the 615 low here from April 10th. And I think that's significant because next up here is our magnet. Now this is drawn off of this number right here. So this indicator is drawing all these retracements off of this high and this decay. So it's just this move here. And then lower we go, we're counting July corn to 577 all the way down to 565 and potentially lower with a low 5 print that could materialize if this thing were to really roll over. So for today, the only conclusion you can have on this chart is that that's bearish. It's met all of the requirements, and what we want to see to really confirm a downtrend is an up-down sequence that confirms a lower low with a lower high followed by a lower low, and that'll really entrench the downtrend into this setup. So I wouldn't be surprised to see a small rally in the early next week that should be sold and then move forward, and barring some surprise demand event, weather event, global geopolitical event that sends us higher, I think lower is the way you have to look there. And here is your December corn contract. Same thing, again, being a little bit more conservative with December corn, drawing it from this March 29th high. It counts all the way down to $5, right? So you could see December corn really accelerate itself lower here. You can see we broke these lows right in here and violated all this support. So the only way you can look at this chart in good faith, in my opinion, is you got to look lower, and you're going to have to look for re-ownership opportunities from lower levels. And this is not a situation where I think you should sit on your laurels and say, hey, I missed it, I don't want to sell it because I don't want lower prices. Remember, as a farmer, we fall into this mindset of, oh, it's got to come back up. It's too cheap, right? The basis is good. Demand is good. Western Kansas is in a drought. No one's going to grow the bushels. We've got planting delays. We've got all this stuff. Plus that, our break even is too high. There's no way that prices can go lower. And guys, remember how it felt in 2013. Remember what it felt like in 15, 16, 17, 18, where the market did not respect your cost of production. It does not care about your profit margin. The market does not care. And that's not because it's heartless, it's because it's just a market. It doesn't have a feeling, it doesn't have a thought. It just goes. And so as far as this market is looking right here, looks like it should be headed lower. We shrug off this 13 and started a new down count. So down we look here in December corn until the market tells us otherwise. Okay, now let's look at our soybean chart. Here is the old crop contract. Oh, that's corn. Where's my beans? Here's beans. Here's our old crop bean contract, and we are holding the bottom end of this range. We did not violate this Astra hedge line here, but we did break these lows right in here, and so lower is where you should be looking. And if you draw this extension off of this intermediate peak here, which counts off of this wave of decline, what you end up with, it counts somewhere down into the mid 13s all the way down into the low 12s off of the old crop contracts. So there's a lot of downward momentum here and a lot of down opportunity. Where are we in relationship to our cloud? Well, we're below it, And really, until we climb back up above it and get a good decisive close above 62 in this time frame out here, then I think lower is where you have to look, and that's where your attention has to be, with a small chance, small carrot that, hey, we haven't quite violated the bottom side of this sell zone right in here, but I would not be surprised at all if we bounce out of that on Monday and we take ourselves lower. Now, new crop soybeans aren't looking any better. New crop soybeans, if you draw the extensions off of this wave of decay, you are talking about moves all the way to low 12s down into low 11s. And so basically, if this lower trend line right here it gets violated, then I would expect an acceleration down to first this low and really down into this low right here. And then maybe we'll find some support down into this 12, 13 range. But then we might get a small rally and then a further down move from there. So I wouldn't be a bit surprised to see this thing accelerate in the next week across all the old crop contracts, across wheat and across soybeans. So I think lower we've got to look until something materializes that makes us think otherwise. And the last 3 days price action certainly did a lot to destroy the bullishness that had been developed up in here, and I hope we're clear about that. Last thing that I want to do is talk about the corn balance sheet, because I want you to see it. If we do end up with about 92 million acres, and we end up with a 181.5 yield, you're going to have a carryout of 2.33 billion bushels of corn. And if perfect weather persists and we end up breaking that high yield, and or demand gets worse from just some type of destruction, then you could end up looking worse. So these ideas that the lower end of these ranges are in reach, they're very much in reach if these carryouts get printed. And same with beans. I don't think that's quite bearish enough to get us all the way down there, because in 15, 16, 17, 18, we capped out at nearly a billion bushels of excess beans. But nevertheless, if we start to push above this 350 number up into the 500s, then supply is plentiful. And if the crops in South America continue to come at us like waves, then our carryout's going to grow by default. Because remember, today the Brazilian ports are somewhere between $1.25 and $2 cheaper than we are at the Gulf. So lower, we've got to look on across the board on old crop and new crop, corn and beans, in our opinion. All right, that's what I have for you this afternoon. I hope you guys have a great weekend. Remember, there is risk when you're trading commodity futures and options, and you should only do so in light of your own financial condition. And please talk to people, talk to professionals about how you can be best positioned to take advantage or to maximize yourself in these markets. Best of luck to you. Have a great weekend. We will talk to you next week.